Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Now you'll notice I'm don't have the Atlantic Ocean behind me this week like we did last week. We're back in our offices helping our clients figure out their financial situations, and nothing makes us happier. And remember, our aim with these videos is to provide you, our valued clients, something brief that gives you information that's helpful to your understandings of the markets while also drowning out the agenda of the news media in America. So what are the four things we learned in the markets this week? Well, first, a pro-business Supreme Court. That seems to be what we have right now. According to Axios, in 2020, when the Supreme Court heard cases involving a business, they ruled in favor of the business 83% of the time. Now, why is it important for an investment firm like us to be thinking or talking about that? Well, there's many reasons. But one of the reasons we think the market did so well under President Trump for 4 years is that he was very business friendly. This allows for earnings and profit growth that can really be juiced up and help the stock market provide above average type returns. We should note that most businesses that do have long-term viability, while profitable, they should be improving their customers' lives and their users' lives very tremendously. But operating in a pro-business environment just makes the profit side a little bit easier. Point number two, with the U.S. economy slowing down, disparity between open positions and unemployed workers should start narrowing a bit. Openings need to drop by about 3.7 million in order to get back to their pre-pandemic level of February 2020. Now, Federal Reserve Chair Powell views the difference between openings and unemployed workers as the driving wedge that keeps pushing inflation up and is fueling price inflation. When job openings peaked in March, that same month the Federal Reserve began to raise near-term interest rates, and we are certainly going to make sure we keep watching those job openings over the next couple months because it's a high indicator of what the Fed's going to do. Point number three, with U.S. corporate profitability being remarkably high, even a shallow recession, which of course is being engineered by the Fed to reduce inflation, should not hurt earnings as much as a typical recession and downturn. After that slowdown comes around, the Fed will finally be able to tame interest rates, and corporate earnings should then quickly start to hit new highs. And the fourth thing we learned in the markets this week, should global equities continue to gain traction in the next coming months, many market commentators may start recommending non-US equity markets due to their valuation discounts to American stock markets, meaning that international markets are cheaper, their stocks are cheaper than US stocks. Now take this recommendation with a grain of salt because emerging market stocks and what we call the EFA, Europe, Australia, Asia, and the Far East, those stocks can work at select parts of a global market cycle. However, you must time your entry, but also your exit really well when going into different countries. The last 2.5 years have shown that valuation means very little, as international stocks have been cheap over that whole time relative to US stocks, yet still underperform their US brethren. It's why we typically have an allocation to international stocks that we keep pretty consistent regardless of what valuations look like. If you have any questions about the things we talked about in this week's market video, please reach out to your advisor by clicking the link in the notes of this video or clicking the schedule a meeting button to schedule a meeting with your individual advisor. We thank you so much and look forward to seeing you next week.